All right, interim reviews. Let's talk about this concept. We talk about this in multiple lessons, but let's talk about it here as well. Now, some of you in the real world out there may have done interim reviews, interim work, interim testing. We're going to talk about this concept and what is this? This applies to audits as well. Interim reviews are reviews of financial statements conducted before the period under review is complete. You could also say interim audit testing is testing conducted before the period under audit is complete. And kind of what's the idea here? Audits, right? Audits can also be conducted in the interim, halfway through the year, 3/4 into the year. The reason for this is to get a jump on the engagement and complete part of the work when it's more slow at a firm. So let's think about your classic fiscal year client. Your busy season is going to be maybe a financial reporting deadline being, say, 4/15. So your busy season is going to be February, March, April, right? Somewhere around there. Now, you theoretically can do some of the work. Like you could theoretically probably audit half of the year around November, right? You can audit January to June in November, October, somewhere around then. And that's kind of getting a jump and getting some work done ahead of time. Now, in reality, even if you do that, you're still going to go ahead and audit the entire year anyway. It's kind of the joke. Some of you may have experienced this where you're doing it and the interim, and you're like, oh, okay, in theory this should be saving us some time, but the partners, those in charge of the audit, make you do the whole thing again anyway. So it's just something that and maybe this has benefited some of you out there. I'd love to hear from you, all of your experience. For small clients and for the purposes of the exam, an engagement can be conducted solely on interim financial information. And that's actually an interesting point because while you're not auditing the entire year, let's say you complete the audit actually before the financial statements are even done because it's before year end. You might think, well, that's just crazy, Nick. What are you telling me? I can do an audit before the year's actually over. And like I said, for smaller clients and for the purposes of the exam, you can. And we're going to talk about this more when we see audit risk. But kind of the idea here is, let's say you audit the vast majority of the client, in certain circumstances, if there's very minimal risk, if there's low control risk, low detection risk, if there's low audit risk overall, you can actually get the majority of your testing done and just complete the audit. Now, again, this is, I'd say theoretically, but that is something to be known. If you do enough work, then you're good to go, right? Maybe there's 2 months left, and those 2 months, you've done enough work, you've tested controls enough, and you have enough security and confidence that there won't be issues, then that's fine. What are some risks with interim testing? Well, interim testing and using an interim date to test substantively instead of a balance sheet date increases the risk that errors closer to the balance sheet date will not be detected. And obviously, because you're not testing during that period. So if you've got those errors, you want to make sure you're catching them. And guess what? If you test at the interim date and not after that, like let's say you test at 6/30 halfway throughout the year, anything from July 1st to the end of the year is not going to be caught. That's a concern. And like I said, the risk is low enough. It's fine. It's kind of a case-by-case basis. If an auditor decides to pursue interim testing, the auditor should assess the difficulty in controlling the incremental audit risk. And incremental risk is the increased risk that errors may not be detected at the balance sheet date because audit procedures were performed at an interim date. So we should assess this, make a note of it, think about it. Is this going to be a problem? Next up, an increase in the tolerable misstatement could cause the auditor to perform testing procedures further from the balance sheet date, whereas a decrease would cause procedures to be performed closer to the balance sheet date. And this is just kind of like that inverse, that relationship concept where what's the relationship between risk and the tolerable misstatement and detection risk, control risk, overall audit risk? Well, as the tolerable misstatement increases, meaning we can tolerate more errors, we can tolerate more misstatements, we could actually test less. Because if we, let's say, we can accept 1% error, but now the tolerable rate, what we can tolerate, what we're okay with, now we can tolerate 3% risk. Maybe that translates to us saying, okay, we were going to test for the full year in November, right? Even though it's a full fiscal year and goes into December. But now because we can tolerate more risk, maybe now we test in October. So we test when only 10 months have been completed. Similarly, and vice versa, if the tolerable misstatement decreases, meaning we cannot tolerate as much, meaning we're not going to be okay with more misstatements, then we would do it closer to the balance sheet date, covering the entire year. Lastly here, interim review reports may only be issued if the scope of inquiry and analytical procedures has not been restricted. So if the scope has not been restricted, then yeah, you can issue this interim review report, be good to go. What's the process here for interim testing? Well, when planning a review of an audit client's interim financial statements, the accountant should consider the results of audit procedures performed with respect to the current year's financial statements to update the accountant's knowledge about the entity's business and its internal control. So, in an accountant's review of financial interim information, the accountant typically performs each of the following. You're going to read the available minutes of the latest stockholders' meeting. You're going to apply financial ratios to the interim financial information. And lastly, inquire of the accounting department's management. When we're talking about interim testing here, we're talking about interim reviews. Now, like I said, you could be talking about this is very intertwined. The interim testing for reviews and interim testing for audits. But you see here, specifically, we're talking about interim testing for reviews. So these are the only actions you take for a review, drilling that home, making sure you memorize what sorts of actions are actually taken for a review. And remember that during reviews, there are no inquiries of third parties, such as customers and vendors, legal counsel, and others, right? So there's none of that. You only are talking to management and the client. And additionally, during reviews, independence is required. Well, it's always super important to come to an understanding with the audit committee, regardless of the engagement type, whether it's an interim testing, review, audit. However, let's talk about those matters, which are going to be specific to interim testing. And some of these may be for an engagement overall. We'll talk it through and have a good time doing it. An understanding with the audit committee regarding a review of interim financial information generally includes the following matters. So you're coming to an understanding. Who is the audit committee? Remember, they are a subcommittee of the board of directors. They're the ones who are in charge of vetting you and hiring you, making sure you're up for the job. And I'm sure you will be because you'll be nice and prepared and an expert in accounting. What's going to come up? Well, the objective of a review of interim financial information is to provide the accountant with a basis for communicating whether he or she is aware of any material modifications that should be made to the interim financial information for it to conform with GAAP. So, what are you going to do? You're going to communicate what the objective of the engagement is. In this case, we're presuming that this is just, let's say, half of an engagement, right? It's a review of interim information. So essentially, it's a January to June. And I mean, it could be other months. I'm just saying this is a more standard fiscal year. In this case, we are doing a review of half of the year. Now, in coming to an understanding with the audit committee involves acknowledging that the objective is not to provide an opinion, right? We see there's nothing about an opinion here. However, it's providing them with a basis to be able to communicate whether the reviewer is aware of any material modifications. Similarly, if this was an audit of interim information, it would be the same exact thing, except instead of it saying basis for communicating about material modifications, it would say basis for an opinion. Next up, management is responsible for the financial information. That's just one we're going to see over and over, right? I just want to drill that down. I mean, you see this in multiple lessons, see this for all of our engagement types right here. Management's responsible for internal controls. We see that a lot. Management is responsible for identifying and ensuring that the entity complies with laws and regulations. We see this as well. Drilling it down. If you get these wrong in the test, I'm going to pull my hair out. Don't make me do that. Management is responsible for making all financial records and related information available to the accountant, just like in an audit. No scope limitations. And lastly, here at the conclusion of the engagement, management will provide the accountant with a letter confirming certain representations it made during the review. Similar to an audit, we've got the management representation letter. You want to come to an understanding with whoever you're working with to make sure that there's going to be no discrepancies at the end of the engagement. Some other points here. Now, break this down, right? We got a nice big blob from the AICPA. Continuing on here. Other agreements and understandings you want to come to are management is responsible for adjusting interim financial information to correct any material misstatements. Okay, very good. Makes sense. That's the whole point of the review engagement, is to find any material misstatements, and if you do, management's going to correct them. Although a review of interim financial information is not designed to obtain reasonable assurance, that's an audit, management also is responsible for affirming in its representation letter to the accountant that the effects of any uncorrected misstatements aggregated by the accountant during the current engagement or pertaining to the current year period under audit, not audit, review, are immaterial, both individually and in the aggregate. What this is saying, the purpose of a review is not here to obtain reasonable assurance. That's an audit. However, despite that, management needs to give a representation letter to the reviewer saying that the effects of any uncorrected misstatements that the accountant, because the accountant can't force this person at gunpoint to make these changes, right? I mean, the accountant can say, "Did you make those changes? Did you make those changes?" You know, if management doesn't make the changes, whether they lie to them and say, "Yeah, we made the changes," or "No, we didn't." This is kind of to cover the accountant's butt, right? They get a letter at the end saying, "Okay, the reviewer found X, Y, and Z, these material misstatements." Management now is to give the reviewer a letter saying, "Yes, we adjusted any misstatements that were material individually and in the aggregate to the interim financial statements as a whole. We corrected them, we dealt with them. So if they actually didn't do it, well, the auditor has, not the auditor, the reviewer has a statement, has a letter from management saying they did." So it's kind of putting the responsibility back on management. We see there's definitely a lot of similarities between audits and reviews. Really, the biggest thing is the change in the difference in scope and the outcome. Rather than an opinion, we have this situation where we are looking for material misstatements. The accountant is responsible for conducting the review in accordance with standards of the PCAOB. Now, this is per the PCAOB. You also have AICPA standards. A review of interim financial information consists principally of performing analytical procedures and making inquiries. We've seen that a million times. So, again, if you get that wrong, I will not have any hair left because I'll be pulling it out. It is substantially less in scope than an audit, drilling that down, right? We've seen that conducted in accordance with the standards of the PCAOB, and then also we've got the AICPA as well, the objective of which is the expression of an opinion regarding the financial statements as a whole. Accordingly, the accountant will not express an opinion on the interim financial information. So this is with the understanding that this might be an interim review, which will then go into the full year review. Both can be done. Maybe you're engaged just to do a review of interim financial information. Maybe you're doing a review of interim information, which will then go into your full review. That's what we're saying here. The objective is financial statements as a whole to give an opinion. However, you're not going to give an opinion just on the interim information, right? We see here a review of interim information is not designed to give an opinion, right? This review, the purpose of the review is to pick up any uncorrected misstatements and try to get them corrected. I say try because, again, you can't really force management to do anything there. An understanding with the audit committee regarding a review is also going to include that a review includes obtaining sufficient knowledge of the entity's business and its internal control as it relates to the preparation of both annual and interim financial information. Basically, we got to come to an agreement. Hey, guess what, audit committee? We're going to have to obtain knowledge about your business and your internal controls so that we can identify the types of potential material misstatements and consider the likelihood of their occurrence. We also need to do this in order to select the inquiries. Remember, this is internal inquiries only, not third party, not external inquiries, and analytical procedures that will provide the accountant with a basis for communicating about any material modifications that need to be made. This is the purpose, right? We need to let them know. Now, you might think a lot of these, well, duh, of course, that's going to have to be, said, and I know that already. But the point here, all of these points need to be known to the audit committee because we're going into business with them and we're doing a service for them. So there can't be anything up in the air. And guess what? While you're quite knowledgeable in this area, maybe the audit committee isn't. So this is why these points will be included in specific communications to that group. A review is not designed to provide assurance on internal control or to identify significant deficiencies. However, the accountant is responsible for communicating with the audit committee or others with equivalent authority or responsibility any significant deficiencies that come to his or her attention. Similar to an audit, similar to most engagements, it's not your responsibility to go find these errors, these deficiencies. However, if you do come across something, just let them know. It's not going to cause you too much harm, right? Find some problem, see something, say something. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started. So why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.